the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, European equity markets have experienced strong momentum since the beginning of the year, driven by increased fiscal spending plans from Germany and the EU, improving prospects of a Ukraine ceasefire, and falling energy prices. Now, this has led to optimism that the region's economic underperformance could be coming to an end, with the potential for European corporate earnings to improve. However, challenges remain, including trade uncertainties and political risks that could impact key sectors, especially those reliant on exports. So how sustainable is the current market momentum given the ongoing political risks and trade uncertainties? Is the market fully pricing in the potential long-term economic shift, or is there still room for growth? Well, to find out more, joining me now is Bill Papadakis, who is the Senior Macro Strategist at Lombard Odier. Bill, welcome to the show.
Nice to be with you.
Thank you so much for joining us, Bill. It looks like European stocks have seen impressive gains and continue to outperform or perform well year to date. Now, the German DAX is up 15% and France's CAC 40 index has gained 9% for the year. What's been driving this positive momentum in European markets?
I should start by saying here that, of course, this is a very valid description up until a few days ago when we were hit by a global trade shock that has taken global stock indices way lower than where they were before, but maybe taking us back to the days before those announcements coming out of the U.S. I think the major factors that drove that positive momentum we saw in Europe was starting the fact that the starting point was pretty low to begin with, and that finally we had a major change in terms of European fiscal stance. One element that we've been arguing for years that was unduly restrictive in terms of the German fiscal policy, which had plenty of capacity to spend and invest in the economy, but was being held back by political constraints. In the aftermath of the recent elections, we saw a major change in that respect, with €500 billion infrastructure plans, much more on defense, and even further fiscal easing taking place across the continent. So this was a much-needed change in trend, and it probably signifies positive momentum in these sectors that can continue much further.
Right. Well, despite the pullback that we are seeing in global markets right now because of the Trump tariffs, do you think European markets, had moved too far, too fast? Should investors stay cautious?
Thinking again, before the trade shock that we're experiencing right now, I would say that while the question itself is valid given the speed of the rally that we saw in European stock markets, I think once again we should place that in a context of a market that was lagging behind over a number of years, especially when you compare to the equivalents in the U.S., and a very major change in fiscal policy that would lead to trillions of euros in spending in the years to come, especially once you consider how sort of underinvested the defense and security infrastructure in Europe has been for years. The companies that operate in that space now have a huge pipeline that they can take advantage of. So I don't think that this recovery that we experienced at the start of the year was necessarily too far. I do think there is plenty of potential there if you assume that the trend can extend for a number of years.
Right. Well, since European markets have seen such a great start to the year, did the recent Trump tariffs have a big impact on European markets?
It's a major shock for the global economy, not just for Europe itself, that maybe has also the firepower to manage some of the implications that come from the U.S. announcements. But I think once you consider the sort of aggressive stance that the U.S. policymakers are taking, and also the lack of process and certainty around how we move on from here, you have to assume that Europe, which to a large extent is also reliant on foreign demand in its economy, domestic demand is generally not sufficient to move the economy forward very strongly. it's a very likely scenario that both the direct impacts from tariffs being imposed on European industry, but also the indirect effects by being caught in the middle of a global trade war with very high uncertainty that's still rising, the implications will be quite severe. So there are levers that European policymakers can pull to cushion that blow, but make no mistake, this is a serious blow.
Well, since European markets had such a good run up until, the Trump trade tariffs announcement, do you see the European markets recovering soon? Will they continue on their momentum once they've recovered from this Trump tariffs?
I think at this point there is a huge question mark about U.S. trade policy and consequently global trade policy. And unless and until that question mark is resolved in some way that gives us a little bit of certainty about the way forward, it's hard to talk about, ongoing momentum in a rally that pre-existed that shock. I mean, right now, analysts everywhere are starting to worry about the possibility of a recession in the U.S. and possibly a global one. So if that's the context that we're talking in, I think it's really hard to consider a rally starting right now. These questions need to be settled first so that we can go back to the pre-existing dynamics.
I see. Well, overall then, how do you assess the potential for a multi-year economic shift in Europe that could close the gap with the U.S.? Do you think the shift is already priced into current valuations?
So as I was mentioning earlier, I think the shift is really major and it has to be considered across a number of dimensions. So I think given the change that we saw in such rapid and massive fashion in Germany and the possibility that other countries to some extent follow along that example, I think it's right to speak about a multi-year trend that is changing, especially in terms of defense and security. One of the sort of paradoxical consequences of the second Trump term taking such a different turn on policy aspects is that Europe finally has to take its own decisions and its own responsibilities on some areas that previously had been very poorly thought of. So I do think we're only in the beginning of that trend. We're getting some very strong signals, and if we extrapolate based on that, we can see meaningful developments. So while there has been a repricing so far, just as I was alluding to earlier, given the scale and the scope for change that we see now, I wouldn't be surprised if that repricing continues further. Once again, we're now in the middle of haze given the global trade shock, but absent that, I think there would still be plenty of scope for reconsidering the possible momentum in European markets.
Well, let's also take a look at some specific sectors here, Bill. The luxury and semiconductor sectors had been performing well prior to Trump's announcement of tariffs. What are the opportunities presented in these sectors, and why have they been so appealing to investors?
These are primarily export-dependent sectors that Europe has in some ways excelled in. And of course, if there wasn't for a global trade shock, we could see the potential for further improvements if the world economy was pulling forward at a strong pace and innovation in these sectors was about to continue. Right now, under the impact of very severe tariff rates, I think one has to be seriously worried about, what export sectors in Europe, but also elsewhere can do. So we have to be a little skeptical about the potential for a sharp recovery unless the uncertainty on the trade front is reduced meaningfully in the near term. The longer the uncertainty lasts, the harder the environment would be, and business decisions will have to be frozen, postponed, or even cancelled altogether in that context.
Right. Well, meanwhile, the banking sector has had strong performance in 2025 due to favorable net interest margins and fee income growth. However, valuations seem to be approaching historical averages. Would you advise caution, or do you see further upside in this sector?
Once again, it's an environment that speaks to the benefit of caution, given that the financial sector is essentially a leveraged play on the economy. And if you cannot be too confident about the future of the economy, then by extension, it makes sense to be cautious on the banking sector and on the financial sector. But I do agree with the points made in the question that, the pre-existing reality was one where European banking sector had reformed meaningfully, had improved its profitability, and the interest rate environment that we had found ourselves in was much different to the previous decade of zero or negative interest rates in Europe. So if that environment was to persist, then there is certainly some optimistic scenarios that one can envision in the financial sector.
What about in terms of European corporate bonds here? I mean, they've outperformed their U.S. counterparts recently. Given the Trump tariffs, do they have any impact on European corporate bonds? Will they continue to sustain this trend?
It's the same story, I guess, to a certain extent with the stock market, right? We're talking about a risky asset class here, which in the face of a severe shock, of course, is suffering some serious losses, and the performance in the near term depends crucially on what kind of an environment we end up in, both in terms of uncertainty but also in terms of growth. Again, I think policymakers in Europe have some levers that they can pull, at least to make sure that the worst case scenarios are avoided. So we don't end up in an environment with, widespread defaults, etc. But between here and there, between getting to a point where policy needs to step in, I think there's still, a risky environment which inevitably this asset class is facing.
Right. Well, in terms of currency, up until the Trump tariffs, the euro-dollar exchange rate surged above 1.09 back in March, reversing a 5-month trend that favored the dollar. How about at the moment? How does the pair look like?
I mean, the euro has strengthened a little further since then, mostly on the back of negative developments out of U.S. trade policy that have led the dollar to weaken against many major currencies. That includes the euro, but also the Japanese yen, the Swiss franc, the sterling. So I don't think it's a euro-specific development that we are talking about in the current context. I think in the future there are a number of variables that one would have to consider. Yes, it certainly does look like the primacy of the U.S. economy is at the very least diminishing, and the growth gap between the U.S. and Europe is also narrowing. And in that context, there was a certain benefit for the single currency in the euro area. But you also have to consider what the path of interest rates will be. And we were assuming, at least in the euro area, some rate cuts to be happening in the near term still, because inflation is so low and there was still a certain concern about growth. By contrast, in the U.S., rates are much higher and inflation hasn't come down as rapidly. So the interest rate environment was arguing in favor of dollar strength. So stronger euro at this point wouldn't be a trend that we would advise chasing further.
Well, overall, Bill, how do you assess the risk-reward scenario for European equities, particularly in the context of fiscal expansion and high valuations in some sectors like banks?
The fiscal expansion, like I said before, is undoubtedly a big positive, and it has happened in much quicker and sharper fashion than pretty much anyone was expecting. But right now, when you have to make a call about European equities or, frankly, any other equity market elsewhere, you have to make a call on which, direction of travel we will take globally in terms of this trade war. Do we end up with some deals being struck that give us lower tariff rates and more certainty about the future? Or do we end up in a retaliation scenario with higher tariff rates and heightened uncertainty that most likely ends up in recession territory? If you really have to worry seriously about a recession scenario, well, the risk-reward about equities in general looks relatively poor.
Well, given the mixed outlook for growth, inflation, and geopolitical risks here, Bill, what would be your primary concerns for European markets over the next 6 to 12 months, and how might these risks affect corporate earnings and broader market performance?
Similar to the point I made earlier, I think the primary concern right now is what happens on the trade front. If we end up in a somewhat benign scenario where some of the threats that were made last week are sort of walked back, bilateral conversations take place, and they help us end up in a scenario of deals being stuck and tariff rates going lower, then that is a relatively benign scenario that could help us recover at least some of the ground from the very sharp falls we've seen in the last few trading sessions. But if there is no light in the end of the tunnel and these high tariffs are here to stay, and Europe is forced to perhaps retaliate against U.S. tariffs in similar fashion, where this is a very bad scenario for global trade environment, but also for economic growth and for corporate growth as a result. So we would be seriously concerned the market performance on that framework.
That's some great insights there. Well, thank you so much, Bill, for joining me today.
It was my pleasure to be with you. Have a great day.
Thank you. That was Bill Papadakis, who is a senior macro strategist at Lombard Odier. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.